Next, let's examine some of the justifications and motivations for diversification. What are the reasons why companies diversify? And in particular, let's look at some of the good reasons for companies to diversify and some not so good reasons, even some bad reasons for companies to diversify. Now, I raise this issue of good versus bad reasons for diversification because diversification is one of those strategic moves where the interests of shareholders may be in conflict with the interests of managers. Indeed, according to some research that's been done in the field of finance, there is good support for the idea that it is, if not often, then at least sometimes the case that the best interests of managers and the best interest of shareholders is in conflict in diversification moves. So let's take a look at 6 reasons why companies sometimes say that they diversify. And you can see that I've got these 6 reasons here organized in a spectrum or a continuum from the left to the right. The first reason is reducing risk. The second reason is maintaining growth. The third reason is balancing cash flows. The fourth reason is sharing infrastructure. The fifth reason is increasing market power. And the sixth reason is exploiting core competencies. Okay, now I've got these organized in this order for a reason, because the reasons that are, the justifications and reasons that are on the left tend to have the least power to create value for shareholders. The ones that are on the right tend to have the most power to create value for shareholders. The ones that are on the left tend to benefit managers more, often at shareholders' expense. The reasons and justifications that are on the right tend to be primarily beneficial to company shareholders and less so to company managers. And so as a result, the reasons and justifications that are on the left tend to be the least defensible reasons to diversify, while those that are on the right tend to be the most defensible reasons to diversify. So let me walk these through one at a time. Let's start with reducing risk. Companies often say that they're diversifying in order to reduce risk.
For example, in the 1970s, when music recording company EMI diversified into the medical electronics industry by entering the CT scanner market, that was their basic motivation for diversifying. They wanted to reduce risk.
So the idea of reducing risk is that you have multiple business units that are sort of counter-cyclical to each other, right? At certain points in the business cycle, some are high, and at that same point in the business cycle, others are low. And so the gains being made by some business units will offset the losses being made by others, and at any given time, and therefore make the revenue streams and the profit streams more stable over time, less risky. Okay. Well, the trouble with this logic as a justification for diversification is that shareholders can already gain this risk reduction for themselves. They don't need managers to do this for them. Shareholders can, by diversifying their portfolio, they can hold stocks in a wide variety of different companies across different industries, across different countries and different economies. And so shareholders can get basically all the risk reduction that they need on their own. They don't need managers to do this for them. They can do this by holding a diversified portfolio of individual stocks on their own, or they can do it indirectly through a mutual fund that holds a diversified portfolio of stocks. So the managers are not performing a service for shareholders that the shareholders couldn't perform for themselves. So what some research in finance has shown is that frequently managers will over-diversify firms in order to reduce their own personal risk, the personal risk of the manager's wealth, right? Because if you think about it, even though shareholders can hold very diversified portfolios with their wealth, and so that their wealth, their personal wealth, is not particularly sensitive to the fortunes of any one company, that's what shareholders can do. Shareholders can diversify so that their personal fortunes are not sensitive to the ups and downs of a one given company. But managers really can't do that. managers, for the most part, their personal wealth, their personal fortune is very much tied to the ups and downs of the particular company that they're managing, right? And so managers have a much greater incentive to diversify the firms that they manage than their shareholders do. And because managers have a greater incentive to diversify than shareholders do, they will tend to pay more for the firms that they acquire in order to diversify than shareholders would like them to pay, right? Shareholders would not like the managers to pay more than these firms are worth, but managers may be willing to pay more than these firms are worth because it benefits them personally to have these firms in the corporate portfolio of companies owned by the corporation in order to reduce their own personal risk, the risk to their own personal wealth. Okay, so that's why that explanation is way over to the left on the spectrum. Least power to create value, most beneficial to managers at shareholders' expense, and least defensible. Now, the next reason is maintaining growth. And this can be a bit controversial when I explain this to managers, so I don't expect everybody to be fully in agreement. However, we've already seen case studies in this course, such as Crown, Cork, and Seal and Walmart, where the main reason for companies' diversification was to maintain growth, to get bigger, right? We talked about with the Crown, Cork, and Seal case and with the Walmart case, we talked about those companies as companies that had fallen into what we called Porter's growth trap, based on what he wrote in his 1996 What is Strategy article, at the last third of that article where he talks about the growth trap. Okay, so why is this not in shareholders' best interests, right? Because you often read about Wall Street analysts as being vigorously in support of growth, right? And punishing firms by dropping their share prices if they are not growing enough. The fact is that shareholders and Wall Street analysts, by extension, do value growth, but what they value is profitable growth. If a firm has a profitable business model and they're not growing it fast enough, yes, those shareholders will punish that management by reducing the stock price. Absolutely. But shareholders do not have an interest in unprofitable growth. As a shareholder, you would rather own shares in a small but profitable company than own shares in a large, unprofitable company. And so, while shareholders like profitable growth, they will severely punish firms for growing in ways that are unprofitable. And again, that's what we saw in the Crown, Cork, and Seal case, and that's what we saw again in the Walmart case. Shareholders punishing management for growing in ways that were unprofitable, or at least relatively less profitable than the other growth options that were available to them at the time. Okay, so here's the main message I wanted you to take away in terms of maintaining growth. As a shareholder interested in profitable growth, growth benefits me when it profits the company. And that usually happens when there are economies of scale or economies of scope or some type of network externalities or network economies where overall being larger confers a competitive advantage on the firm in some way or other, so that larger size means higher profits. Okay? In those situations, shareholders benefit from growth. In other situations, as we saw with Crown, Cork, and Seal and Walmart, shareholders do not benefit from growth. But regardless of whether shareholders benefit from growth or don't benefit from growth, managers typically do benefit from growth regardless. And why is that? We find in research that CEO compensation is much, much more closely tied to the size of the company that they manage than to its profitability. CEOs of big companies get paid more than CEOs of small companies, whereas CEOs of profitable companies don't get paid that much more than CEOs of less profitable companies. So that's just what the empirical research shows, that CEO compensation is much more closely tied to the size of the firm than to the profitability of the firm. It's not that more profitable firms don't pay their CEOs more. They do. But the benefit that a CEO gets from being larger, from having a larger firm, is much greater than the benefit the CEO gets from having a highly profitable firm. Okay, so there's a conflict of interest there. Shareholders want profitable growth because that's what benefits them. Managers want any kind of growth because that's what benefits them, at least the CEOs. Next reason, balancing cash flows. Here the argument has been that there can be different units, different business units at different stages of the industry life cycle or the business unit life cycle, right? You may have small startup business units that are in emerging industries that require large cash infusions in order to grow and be competitive and perhaps even gain first mover advantages in their industries. On the other hand, you have large mature business units that don't have much opportunity for investing cash, but tend to generate a lot of cash, right? They generate cash and don't have a lot of great opportunities for investing it, whereas small upstart business units in emerging industries have a lot of need for cash in terms of investment opportunities, but don't generate much cash. Okay, so the idea is if you have overall corporation that has some small startup business units in emerging industries and some large cash generating business units in mature industries, then you can funnel the cash from the large mature business units to the small startup business units. That's the basic logic of balancing cash flows. And this is the logic behind some of the strategy matrices that you may have seen. For example, the Boston Consulting Group's famous growth share matrix with the cash cow, the problem child, the dog, and the star. I don't know, you may have seen those. Okay, now what's wrong with this argument? Again, what's wrong with this argument is that this is not something that shareholders can't do for themselves, right? If you are a business that's in a large business that's in a mature industry, and you're generating a lot of cash and don't have much opportunity for investing that cash on your own in that business unit, you can dividend that money back to your shareholders, and they can invest it in the small startup firms that are in emerging industries, right? So this balancing of cash flows is something that shareholders can do for themselves if you dividend the money back to them from the large mature business units. So just as shareholders can do the risk reduction on their own, so too the shareholders can do the balancing of cash flows on their own by receiving dividends from large mature business units in mature industries and investing those dividends into small startup firms in emerging industries. Now, the reason why this balancing cash flows box is not all the way over to the left with reducing risk is that this balancing of cash flows is something that managers can perhaps do slightly better for the shareholders than they can do for themselves. And the reason for that is not any special competence of managers, but has to do with taxation. The way that dividends are taxed means that the balancing of cash flows can be done in a more tax-efficient way within the company than it can be done if you dividend the money back to the shareholders and rely on them to invest that money in the small startup businesses. So that's why this balancing cash flows is somewhere towards the middle of the spectrum. Not that, managers are necessarily all that great at balancing cash flows. It's just that they can do it perhaps in a more tax-efficient way than it can be done if you rely on dividends to get those cash flows going. Okay, that's it for the bad reasons to diversify. Those three on the left, reducing risk, maintaining growth, and balancing cash flows, which are in general bad reasons to diversify. Next, let's move on to the good reasons to diversify. The three on the right, sharing infrastructure, increasing market power, and exploiting core competence. And the reason why these three are generally considered to be good reasons to diversify is that with these three reasons to diversify, you're creating some kind of synergy. That is, in some way, the whole is greater than the sum of the parts. So let's talk about each of the three ways in which the whole can be greater than the sum of the parts. Sharing infrastructure. What we're looking at here is ways that you can achieve economies of scope. That is, ways that you can save money, have lower costs, because you are competing in several different industries rather than just one. You can share infrastructure across business units. So, for example, the EMI case, that the large medical electronics companies like General Electric, could have enormous economies of scope because they wouldn't just be selling CT scanners, they would also be selling a broad range of other medical electronic products, including many that would be much larger in sales volume than the CT scanner. And so GE could have a shared infrastructure in terms of their sales and service staff, the feet on the street, servicing and selling to customers, as well as manufacturing and other things. By sharing that infrastructure of sales and support staff and other areas, manufacturing as well, GE can bring costs down versus a company like EMI, which was basically a one-product company in medical electronics, just produced the CT scanner. It did not have those same opportunities to reduce costs by sharing them across different products. Okay, so other examples of shared infrastructure would be, for example, in the soft drink industry. You have an infrastructure in terms of the bottler network and their distribution to retailers, which is a mechanism that you can use to put lots of different products on, right? You can put lots of different products through those filling lines in the bottling plants and lots of different products on the trucks. By sharing that infrastructure across a fairly broad product line, you can bring down the costs. That's what we call economies of scope. Another example of shared infrastructure would be Amazon.com. Amazon.com was originally set up to be only an online bookseller, and they built an enormous infrastructure to support that mission in terms of their distribution centers and their warehouses and their physical book handling capabilities. And they found basically that all of that infrastructure could be used just as well at very little additional cost to distribute a whole wide range of different products, not just books. And so they diversified into music, electronics, toys and games, home and garden products, and kitchen and houseware type products. So that's another example of shared infrastructure. The main point I want to raise here about shared infrastructure is you're looking for situations, opportunities where some function can be performed more cheaply because you're doing it for two or more different products simultaneously than it could be done if you're doing it for each product individually. That's where you're gaining benefits from shared infrastructure. Okay, the next type of synergy is increasing market power. And, the basic idea here is that if you have multiple business units that either buy from the same set of suppliers or sell to the same set of customers, then by combining them together under one roof, combining your purchases from suppliers or combining your sales to customers, you can gain some additional market power. And this is the basic logic underlying some of the discussions, at least, that you see taking place in the PepsiCo restaurants case, which we will get to soon, where, as you'll see, PepsiCo is trying to coordinate the purchasing across its various restaurant business units in the 1990s. This, again, was before PepsiCo got rid of all of its restaurant chains. They were trying to increase coordination in their purchasing across these different business units, across these different restaurant chains. And the idea there was basically by buying in larger volume, they could gain some market power. Okay, that's fairly straightforward. Finally, the last reason, all the way over on the right here, is the idea of exploiting core competencies. And here, the way that the whole is greater than the sum of the parts is a bit different from the other two. With sharing of infrastructure and increasing market power, the objective is basically reducing your costs by means of either combined purchasing or combined operations across different business units, right? Combined purchasing across different business units give you increased market power. combined operations across different business units gives you, shared infrastructure. And so the idea in those two is you want to reduce costs basically by competing in more than one business unit at the same time. The idea behind exploiting core competencies is really to generate more revenue opportunities because you are competing in multiple businesses, multiple markets simultaneously. And so, an example here would be what Walmart did by offering a very broad range of products to its rural small town customers, including, not only general merchandise, but now pharmaceuticals and groceries. Those are some diversification moves that allow them to generate basically more revenue because they are, exploiting a core competence in distribution across those different product groups.